Hello, everyone. Thank you all for joining. We will be beginning the session very soon. We just want to wait a couple more minutes so that everyone can join us. We have about 30 participants now. I guess, Vivek, we can start. Let me start with introducing the speaker, Mr. Vivek Sharma. Mr. Vivek Sharma is the VP and Investments Head at ST Advisors. He has done his BTech and MTech from IIT Kharagpur and has been in the industry for almost 2 decades now, right, Vivek?
Yeah, 20 years now.
Yeah, so we will be talking about the 4% rule of retirement in this webinar. What this rule is, does it really work in India? And what is the true safe withdrawal rate in India? So, Vivek, over to you.
Thank you, Ankit. And I think haven't given the full introduction. Uh, Let me introduce Ankit Kejriwal, who works in the research area with ST. He does a lot of research related to all the personal finance related stuff, and most of the stuff that you see on blogs, on our social media actually is created by Ankit. Right. So let's get started with the 4% rule. So the reason why we chose this specific topic of 4% is a lot of investors actually get in touch with us, talk about their retirement planning, which is really nice to see. Now people are getting more curious and aware about retirement planning, but they have lots of doubts. So we thought we'll maybe conduct this specific webinar to clear the most frequent questions that we get related to the retirement planning. So yeah. So as I told you, there now good awareness about retirement planning, because overall from the research, from the uh, trend that we see, that most of the people actually don't have any retirement plan, or even if they have any retirement plan, they actually start too late. And why we don't have is because traditionally, uh, for most of us, the retirement plan is actually their children only. That we tend to rely on children to support us financially during the retirement phase. And this was actually working well also till now, because we used to primarily live in joint families, but now because of the formal employment, now families are also getting more and more nuclear. So there's huge demand and need for people to actually think about retirement planning much more seriously, right? And what this impacts is, if you actually fail to plan or if you're late, then these are the impact actually. We are maybe required to work much longer, even if the health or peace of mind does not support that. or you are dependent much more on your family, and obviously it creates a lot of social embarrassment and affects your dignity and self-worth. And that's why it's a very important uh, topic in personal finance that all of us should be aware of, and the sooner we start planning for retirement, the better it is. So in today's session, what we are going to cover is there's a lot of content around retirement planning, and most of it is around that 4% rule. We're going to discuss what exactly that 4% rule is, how it works, and whether that specific rule of 4% actually works in the Indian context or not. And we are going to also talk about India's true safe withdrawal rate, and also discuss some practical retirement planning strategies for longer term success. Right. And please keep sending us your questions. So we'll be definitely more than happy to take all the questions that we have received, and also that we'll receive during the course of this specific webinar. So I'll quickly cover this PPT maybe in next 20-25 minutes, and then we'll happy to take all the questions that we would have received. So let's first try to understand what is safe withdrawal rate. Safe withdrawal rate is the maximum rate that one can withdraw from your retirement portfolio without risking its premature depletion. And the overall period that it normally assumes is at least your retirement corpus should last about 30 years or so. So if you retire at about 60, a 90 years is fairly safe um, age to plan for your retirement. Although I think the average age in Indian context would be somewhere around 75, if I'm not wrong. But it's always during retirement, it's always better to plan much more conservatively, and that's why 30 years is a usual time frame that is taken in retirement. So what it says is, let's say you have a 5 crore corpus as your retirement corpus. So in the first year, you can actually withdraw 4% of whatever corpus you have. So in case of 5 crore, it will be 4% of 5 crore, which is 20 lakhs is what you can withdraw during the first year, which would come out to be somewhere around 1.5 lakhs or so. Right? In the second year, you keep adjusting for inflation. So whatever the inflation is, let's assume the inflation is about 6%. So in the second year, you increase your withdrawal rate from whatever you have withdrawn by the inflation rate, which is 6%. So in the second year, you will be actually withdrawing 21.2 lakhs, and so on and so forth. And at 4%, at least in the initial research, when this specific paper was published in US in, I think, 1994, 4% withdrawal rate gave you a very good success rate of more than 90%. Right. So obviously 4% rule is very, very popular. 30, it lasts for 30 years, but in the Indian context, is it really, really applicable or not? Because India, it's quite different from the way US operates, primarily because of the market returns, and also because of the higher structural inflation that we have. In US, the inflation is much lower as compared to India. We have had, I think, maybe about 3 to 5% higher inflation than US across, and that's why this 4% rule really is not a very safe withdrawal rate. It's actually a very risky withdrawal rate in the Indian context, right? From what research tells us, and we have given the sources also in the bottom, a more balanced research safe withdrawal rate in the Indian context would be somewhere around 3% instead of 4%. So from 4%, what you can derive is, if you divide 100 by 4%, you get 2500, which is 25 times of your annual expenses is what you should have. But as we just seen, that 4% is not really, it does not really work for India. In India, it works, the better rate of withdrawal is about 3%. And if you are aggressive, maybe you can go up to 3.5%. Or if you want to be really conservative in Indian context, it would be coming to be about 2.6%. So the corpus that you should have is not 25 times your yearly expenses. It's more around 35 times, and the range would be about 30 to 40x. So the more aggressive you want to be, you can maybe have about 30x, but definitely 25x is not going to last um whole 30 years, and it's a very good, there's a very good probability that you're going to run out of your money within those 30 years, right? That's what you don't really want in your retirement. Now, I'd just like to discuss why exactly this specific
Vivek,
4% rule
let me
does not.
just stop you there. We are
Yeah.
getting some questions. People are confused what this 30x really means. So if you
Okay.
could
Okay.
explain that
Yeah.
part again.
Sure. So when you take the way to determine how much you need for retirement is based on your expenses. Let's say you have yearly, for simplicity's sake, let's say you have 10 lakhs of expenses in the current lifestyle that you're leading. And this 10 lakhs is the yearly expense. So what 4% rule, if you actually take the 4% rule, you actually come up with 25x. That's what 100 divided by 4%, you will get 2500, and that's how you determine that you'll need 25 times of your yearly expenses. So if your yearly expenses is 10 lakhs, you do 25x of that, and that's how you arrive at 2.5 crores, right? If you actually want to withdraw 4%, but as we have discussed, 4% is very, very risky in the Indian context. So if you take 3%, the rough number that you will get is about 35. So 3% may 100 divided by 3% would be 33.3. We have just taken the rounded number to 35x, which means in the Indian context, 10 lakh worth of yearly expenses would actually translate to the requirement of 10 into 35, that is 3.5 crores. That's how you calculate how much you actually need for your retirement based on your expenses. Obviously, if your expenses are going up, you'll need much higher than that, right? So that's what it is. Okay. Ankit, any more questions related to safe withdrawal rate?
Yeah, Vivek, we are getting one question from Sachin who is asking, I have 1.5 crore rupees right now at the age of 41 and monthly requirement is 40,000. Can I retire comfortably using this sort of rule?
Okay. So see, your monthly requirement is 40,000. That means about 4.8 lakhs per year. Let me just round off for simplicity's sake. Let me just round it off to 5 lakhs per year is what you require uh, at the current stage. Now, this 5 lakhs, what you'll need to do is if you want to take roughly around 3.5%, sorry, one sec, 3.5. Yeah. If you want to take, let's say, aggressive, if you want to be slightly more aggressive and you want to withdraw 3.5x, which means you'll need about 30x of 5 lakhs, which is coming out to be around 1.5 crores only. So, yes, I think it's slightly aggressive. What I would suggest is, frankly, have some more buffer, which means maybe about 20 to 30 lakhs buffer. That will be sufficient for you. But again, in this case, this whole 1.5 crores or 1.78 crores, whatever number we are talking about, this is only meant for retirement. So if you have any other financial goals, let's say to buy a house or any other financial expense, really this 1.5 crore would not be sufficient to cover any other expenses. This is purely meant for retirement. So if this is what your retirement kitty is, then I think yes, maybe you can retire or maybe you can wait another year or so, increase it by 10, 15, 20% in that range, and then you will have sufficient buffer to retire.
We have one another question. Uh, the user is basically asking, should we consider the amount invested in some sort of mutual fund FD as well in this, which gives about 8% CAGR? Would it help in beating the inflation?
So there are two things I think here. One is about how do you invest before retirement, right? When you're still earning. And the second point is, after you have retired, how do you invest then? Right. So it's a question of asset allocation. Now, when you are earning and you haven't reached your retirement corpus, you are actually saving to reach that specific target corpus. At that time, it really helps to have a much higher equity allocation, because equity gives you uh, the highest returns of all asset classes. Equity gives you the best returns, and even though it's more volatile, it does not really impact you because you're not withdrawing anything from your corpus. So during before retirement, when you are actually saving for retirement, you should have much higher percentage in equity. Whereas when you have retired, and I'm going to talk about that concept just after this, when you have retired, you actually should not be having much higher allocation to equity. uh, you should have maybe about 50% is more than sufficient. You should not have more than that. Maybe on the higher side 60, but definitely it's not really going to help you if you have higher allocation to equity during a retirement phase. And that's the topic, next topic I'm actually moving on to, which is the sequence of returns. And why it's not helping you more equity is because of this sequence of returns. Let's understand what it is. So I've taken two cases here. The two cases are, the returns are same exactly. The five returns are minus 10, 12, 15, 20, and 25. These are the five returns. But what matters is the order. So in the first case, you have a early bad start. In the first year, you have seen minus 10%. Whereas in the second case, which is the extreme opposite, is towards the end you have that bad scenario, which is in the fifth year you have bad scenario of minus 10%. But if you're not withdrawing anything or if you're not depositing anything, then it really does not matter. If you start with 100, you're actually going to end up with 174 in both these cases. So the sequence of return does not really impact you if you are not withdrawing or if you are not depositing any money. Now take the next case of when you are depositing. This is when you are saving for retirement. That's when you will be depositing in your retirement kitty. So in that case, if you actually start with 100, and if you have a bad start, first year you have, what it's going to do is you're going to be able to buy much more of equity with whatever you are depositing. And you are going to end up with a much higher amount versus if the bad year comes later. So it's actually always beneficial if you have bad years early on in your when you are saving for retirement. So there's a difference of about 6 lakhs in these two cases, right? Now, if you move on to the next case, which is withdrawals, which is happening when you actually have retired. In that case, an early bad start, it's really bad for you. So in that case, in an early bad start is going to lead to 149 from 100 in 5 years, whereas a bad start later is actually leading to 155. So the biggest risk in this case, as we see, when you have retired and in the early few years, if you have bad returns from equity, that is really, really the biggest risk to your retirement portfolio. And that's how the sequence of return, not so in both these cases, the average return is exactly same, which is slightly north of 12%. But even then, if you are withdrawing and in the initial few years of your retirement, if you have a bad start, uh, that is actually quite a risky thing for you, and that's why you want to uh, be more conservative, and that's why in Indian context also 4% is not really good enough. So if you actually are withdrawing 4%, your failure rate is actually 25%. That is also still high. With retirement, you want to be sure. Obviously, 100% would be way too high, but 90 to 95% success rate is good enough for retirement planning. But if you are actually withdrawing 4% in Indian context, you are going to have only 75% success rate. Rest 25% is the failure rate. But if you have a minus 10% in the first year, which is not too rare if you think about how much volatile Indian markets are, if you have a minus 10% in the first year, then that failure rate actually increases from 25% to 75%, which means you just have a 25% success rate. And that is the sequence of return risk. And that's why 4% in Indian context definitely is not enough, and you should have much more. So again, coming back to that specific question of the asset allocation, uh, it's actually counterintuitive that after you're retired and when you are withdrawing money from your portfolio, having more equity can also hurt you. And in this specific case, as we have shown in the previous case, if you are unlucky and in the first few years you have bad, lower than average returns from equity, that is actually a very big risk for you, and that's going to reduce the overall success rate for your retirement planning. Okay, so it's actually like you're climbing out of a hole, uh, because when the returns have been bad, when you've seen a bad year where your portfolio has shrunk, at that time you're withdrawing much bigger percentage. And when the recovery has started, that recovery is after you have withdrawn, so it's that recovery is actually happening with a lower capital base, right? So it's actually it's like trying to climb out of a hole that is actually getting bigger and bigger. Right. So the next part we come to is the dynamic withdrawal rate. One of the things that you can do during your retirement, if you actually want to last more longer, your retirement money to last more longer, is you switch to a dynamic withdrawal rate. Obviously, it's not ideal because some years you would want to withdraw higher, some years you'd have to withdraw lower, and this is dynamic withdrawal is actually dependent on the markets. So if the markets are doing well, you can actually withdraw slightly more than what you have planned to, and if your investments are struggling, then you have to withdraw slightly lower than what your retirement planning plan tells you. Right. And if you are able to maintain this kind of flexibility, it actually improves the overall sustainability of your portfolio. And the way there are many, many actually methods of withdrawal rate, and one of the method is around the guardrails. And guardrails also you will have many different type of methods within guardrails. So this is we have just given one of the examples, and if you go and search on the internet, there are actually very many very types of dynamic withdrawal strategies, and obviously each one has its own pros and cons. But overall, if you can have this kind of flexibility, it will really help you in overall retirement. So if let's say assume your corpus is 1 crore, you're withdrawing let's say 3.2% of your corpus, which is 3.2 lakhs, and then increasing it as per inflation. But a guardrail is you have a 20% band around the initial withdrawal to manage the fluctuations. So overall, these are the two higher and lower ceilings, and you are not going to go above and below these two numbers, which is 3.2 lakhs minus 20%, which is 2.67 lakhs, and above that, which is you take 20% higher. So your withdrawals is always going to be between these two numbers, right? So the minimum withdrawal amount would be 2.67, which will prevent excessive cuts during the downturn, and the maximum would be 3.8, which will actually cap the spending during the market booms as well. This is how actually guardrails work. Your withdrawals can rise with inflation, but they must stay within the defined floor or ceiling bands. If markets struggle, spending reduces towards the floor, and if market performs well, it gives you more flexibility to spend slightly higher, allowing you to enjoy more. The trade-off here is between the withdrawal rate and the failure rate. So higher withdrawal rate significantly increases the probability of your capital being depleted too soon, and the lower withdrawal rate actually reduces the risk of failure, extending to the longevity of your portfolio. The chart on the right actually is quite an interesting one. This is from the original 1994 research paper published by Benjamin, which was who was a financial planner who came out with this 4% rule. And if you see in this, if you see the middle one, which is for the 4% rule, this actually very clearly tells you, and this is actually valid for the in the Indian context also, that higher equity does not lead to higher withdrawal rates. So if you're going to stick with 4% withdrawal rate and take these five scenarios of 0% stocks, rest in debt, then 25% stocks, 50%, 75 and 100% stock. This is the chart which is giving you the minimum number of years withdrawals will last. So in this 4% rule, if you see, if you have 0% stocks, obviously the growth is not there and your portfolio is not going to last even 20 years. If you increase your stocks to 25% and rest in debt, then it is slightly above 20 years. The highest rate is actually coming at 50%, and then it starts to decline. At 75%, the minimum number of years will actually be lower than what you actually encounter in the 50% stock. So here it's clearly showing you that having higher allocation to stocks, uh, you're actually the minimum number of years your withdrawals will last is going to reduce because of the sequence of return risk that we have just spoken about, right? So the role of equity in growth and risk, growth for higher withdrawal rates to support higher withdrawal rates, it is definitely helpful. Equity is a growth driver, definitely yes. But if we rely too much on equity, if we have too high equity, and if we are unlucky and um, we have bad initial few returns from equity, then the risk of failure actually increases, and you don't want to be reliant on luck for the retirement planning. So that's why it's always suggested to have maybe somewhere between 40 to 60% in equity. The higher equity does not help you, and you are more reliant on luck in that specific case, right? Yeah. So even in the earlier, even in the case of US, the 4% rule came out to be from 50-50 stock and bond portfolio. And even in case of India, that's the balanced view, which you should be taking. Roughly 50% in equity, 50% bond is pretty good, and you can enjoy safe withdrawal rates of about 3.5% of that range. Whereas equity heavy portfolio is actually going to have lower safe withdrawal rates because of the sequence of return risk. Yeah. So that's about it from our side. We're talking about the safe withdrawal rate, which in Indian case ranges from 2.6% to 3.5%, 3% being average. The target corpus size for you should be at least 30 times, 25 times is not good enough in Indian context. And the optimum asset allocation about 40 to 50% in equity. If you want to be more conservative, have lower equity, but having higher equity is not definitely going to help. And an additional 5 to 10% in gold is also recommended based on the research in Indian context, because it gives your portfolio that stability. It does not really help so much in case of returns, but it does introduce some amount of stability in your overall portfolio. So that's about it from our side. Ankit, let's take whatever questions we have received.
Sure, Vivek. Before we hand over the floor to our audience, I have a couple of questions I want to ask you.
Yeah,
Uh,
sure.
Retirement planning is one of the toughest and nastiest subjects out there that is in the finance. And safe withdrawal rate, what it does is it provides a simple answer to a complex problem. And you spoke about dynamic withdrawal rate. It seems a little complicated for a layman. Do you think it is a must, or do you think a static safe withdrawal rate can do the job for most of the people,
I think,
considering the
yeah. See, static safe withdrawal rate is pretty safe actually. Those dynamic withdrawal rates are, if you want to last longer, if your retirement money to last longer, it's required. But again, I think you made a very valid point that in most of these cases, if the plan is simpler, you're going to stick to it. It's easier for you to stick to it, really. So if you are sticking to that standard withdrawal rate of 4%, you start with 4%, adjust with inflation, that is good enough. But maybe you don't need to follow exactly the formula, what the formula tells you. But if you have just very simple flexibility, as I told you, you don't need to really follow those specific numbers, but have very simple flexibility that you can maybe afford to spend slightly higher in case market returns are good, and slightly lower in case your market returns are lower than average, let's say 12%. That would work beautifully. So you don't need to really bring in lot of formulas, lot of calculations in that dynamic withdrawal rate, because that dynamic withdrawal rate, frankly, there's so many studies, so many, I think within dynamic withdrawal rate, there are tens, actually tens of methods, that it's not really fair to go it that deep into it, and keep your plan simple would be my suggestion, really.
That makes sense. Also, you spoke about safe withdrawal rate. So, suppose we are talking about 3% safe withdrawal rate. Does it mean that we have to withdraw 3% of the corpus every single year? Or what does it mean? How does it work?
Yeah, so this is a very common problem, I think, confusion actually. Many people feel that whatever that withdrawal rate that they are following, whether it's 3, 3.5, 4, is what they can withdraw from their portfolio every year. Which means if you are following 3%, you, no matter where your portfolio is, you every year you withdraw 3% from your portfolio. That's not actually how it works. The way it works is, as we have explained initially, you start with that safe withdrawal rate of 3%. It's just the first year that you're withdrawing 3% from your portfolio. And later on, you have to actually adjust it with inflation. So whatever inflation rate says in India, maybe it's about 6% or so. You adjust your withdrawals as per inflation uh, from the next year onwards. That's how the safe withdrawal rate works. But you're right that uh, it's a very common confusion that you actually withdraw same percentage, let's say 3% from your portfolio every year. That's not what is suggested by the safe withdrawal rate.
So, it's only applicable for the first year, and
Yeah,
thereon you just adjust the absolute amount by the inflation.
exactly. Yeah, yeah.
Makes sense. And obviously, you have been in the industry for over 20 years. You have interacted with several investors. So, what do you think are the most common mistakes that people do when it comes to retirement planning?
So I think these are the mistakes even I have made, frankly. One of the most common problems, and that's not only in India, I think it's the world over, that we start this planning a bit too late. It's only towards the end when you are actually closer to retirement, that's when you start planning for retirement. It becomes pretty late at that point of time, really. So the earlier you start, the better it is. That is one thing. Second is also, I think even when you start planning, I see a lot of optimism in terms of your expectations from markets, or the way you assume whatever assumptions you have taken. See, personally, I'm a pretty aggressive investor. I take lots of risk. But this is one risk that I definitely don't want to take, is with my retirement planning, right? I don't want to run out of money, and I don't want to see that longevity risk in my portfolio for retirement planning. So the assumptions that you take, be it in terms of inflation or be it in terms of the returns that you are getting from the market, I think we are always very optimistic in that. And your retirement lasts for good to 20 to 30 years. So even a small change in your assumptions. So let's say you've taken an inflation of 6%, even a very small change of 6 to 6.5%, because we are talking about 2 or 3 decades, that can have a huge, huge impact in your overall scheme, right? And that's why when you mentioned, I think initially, that retirement planning is one of the most challenging problems in personal finance. That is the problem, because you can assume whatever you want to, but if your returns are even 1% lower or inflation is just 1% higher for good 15, 20 years, it can have a very big impact. So that is one problem that I see is we are always too optimistic either about returns, so we assume much higher returns and we assume much lower uh, inflation rates. That is one very common problem that I see. Yeah, those are the two, I think primary ones would be those two.
Yeah, you touched upon a very good point, Vivek. Because we are working with retirement planning, we are assuming a very long period of time. So when the time horizon is such big, even small differences in the estimation can create big impact. It's just like a ship going in certain direction. If you nudge it only a little bit towards right or left, you would not be able to tell much of a difference in the final destination in
Yeah,
the initial part, but over time, the distance between the final destination is going to be huge.
yeah.
Uh, in the last slide, you slightly mentioned that in the portfolio, in the asset allocation, you can have gold as well as part of your portfolio, apart from traditional fixed income and equity. And gold, as we know, is the favorite asset class of Indians. So, what's your opinion on gold? Should we have it in the portfolio or should we avoid it?
See, firstly, I don't have too much of gold in my portfolio. See, the research, it totally depends, and it's not very clear. Gold to me is as volatile as equity markets. And if you see the returns, they haven't been as appealing as equity markets. Now, when I say this, a lot of people are going to question me because obviously in the last 5 years or even 10 years, I think gold has delivered as much as equity markets have delivered. But if you look at very long term, gold hasn't really, has just maybe kept with inflation. Whereas equity is the asset class which has given higher returns than inflation, much higher returns than inflation. So it totally depends on the kind of time frame you're looking at. If you are looking at time frame of 50 years and beyond, the conclusion you are going to get is that gold is not worthwhile having in your portfolio. But if you look at most more recent data of 10, 15, 20 years, the conclusion you will get is definitely having gold helps you stabilize your portfolio. It does not help you in returns, but definitely helps you because it is uncorrelated to equity markets. So I have been now changing my view. Earlier I was dead against gold. Now I think we should have gold depending on how the overall uh, geopolitics is shaping up the movement in gold. I think it's a fair case to have some amount of gold, maybe about 5-7%, but don't go overboard with gold. That's what my view would be.
Okay, and I want to ask a little more about asset allocation before and after retirement. I know you spoke quite a lot about asset allocation throughout the webinar, but this is an important question. This is one of the most important aspect to personal investment planning, asset allocation. So I want to spend more time on this. Can you speak a little about what asset allocation should be before retirement and how it should change after a person has retired?
Yeah. So before retirement, our focus is much more on growth. That's what we are focusing on. And equity provides you the best avenue for growth in your portfolio. So depending on your risk profile, I think you should have anywhere between, say, about even the pretty conservative ones should have maybe about, say, 30% or so much of equity. A balanced view would be about 50 to 60%, and the aggressive ones maybe can go as high as, say, 80% or so in equity because what we have seen in the sequence of return risk that it really helps you when you are having those corrections and you're putting in that money. It really helps you during the growth phase, and that's what the role of equity is. It helps your portfolio grow at a much more faster pace. If you have less of equity, it's going to take longer for you to reach that specific number, your retirement number, right? But in the second phase, definitely you should be much more conservative. Uh, Conservative because it's a matter of retirement and you're not earning. You definitely don't want to be in a phase where you would have to go back to work after you have taken the retirement, right? Maybe your health does not allow, or there could be other reasons, but that will really be a very bad case scenario that you have to again join the workforce after you have taken retirement. And that's why you have to be much more conservative, and you don't want to be reliant on luck. If you are reliant on luck, uh, that's not how you want it to be, especially during a retirement phase. And that's why one should play very safely and have much more diversification in place, have less of equity in place uh, when you have retired. So an aggressive investor should have maybe about 50 to 60% equity. That's about it. And a conservative person maybe have 30 to 40%, and a sorry, a moderate person should have maybe 30 to 40%, and a conservative person maybe about 15 to 20% equity should be okay after retirement. So that's what my view is, key be reliant much more on diversification across asset classes after you have retired.
So the allocation that you just mentioned were perfectly fitting into that 100 minus age equity allocation rule. So do you think it's a good rule to follow up throughout the years?
Yeah, it's interesting you brought that up because I don't think that's a very good rule really. Because what it tells you is at the beginning of your career, when let's say you're 20, early 20s, when you start earning, at that time maybe you can have 70, 75% in equity. And let's say you are in your 40s, you keep reducing your equity allocation. I don't necessarily agree with that because I've seen many people who don't really understand investments when they are in their 20s, whereas when they are in their 40s, they are earning well, uh, they've grown well over past 20 years, built a solid corpus, and they understand equity markets very well and they can afford to take higher risk. So I think that has been the case with me also personally, that over past 20 years, my risk appetite has actually increased considerably, and I think I can afford to take more risk because I'll be earning for next 5, 10, 15 years, whatever that number is. And also I understand equity markets at least much better than what I understood when I started investing. And that's why I feel more comfortable in taking this. So I'm not really sure about that specific rule of 100 minus age, really. Yeah.
Okay, so we would be opening the floor to audience's questions now. We have already received several questions. I'm going to be asking them, Vivek, to you. In the meanwhile, if you have more questions that you want us to answer, please feel free to drop those questions in. So the first question, Vivek, is I'm 42 years old living in tier 1 cities. I have a 7 crore diversified portfolio. So he's a rich guy and he's considering that fire number, the financial independence retirement early. But he owns his own house, but is not very comfortable whether this is enough to retire early. What's your take on this?
Yeah, I think even with me, this is also quite common actually, that we have built a fairly decent retirement corpus. Obviously, he hasn't uh, told what his expenses are, right? But in this case, what I would really advise is talk to a financial advisor. I think that discussion is really going to help him a lot, and they can actually, in that process, he can go through all the worst case, conservative and a more moderate kind of a scenario, that kind of scenario analysis, even for me, when I started my retirement planning, uh, when I actually started systematically saving for retirement and I did these kind of scenario analysis myself, it really helped me a lot in terms of determining where I am in that journey and how close or far I am from that stage. And it really helped me give that peace of mind that I am on the right path. So I think that specific whole financial planning exercise or the retirement planning exercise, if he is able to do with a good financial advisor who is not necessarily just after selling products, so that would be my suggestion. He should definitely consult someone, do that scenario analysis. That is going to help him a lot, really.
We have a question from Shiva Kumar. He's asking whether mutual funds should be considered as equity or should it be considered as debt or what?
So mutual funds, see, are a vehicle. You can actually take exposure or invest in equity also. You can invest in debt also. You can invest in gold through mutual funds. You can invest in real estate through mutual funds, right? So, so it totally depends on what kind of mutual funds you are picking. You can actually invest in all of these asset classes uh, through mutual funds. And obviously there are multiple categories, like for taking exposure to commercial real estate, you have REITs, real estate investment trusts. These are also one type of mutual funds. Then you have equity only. Obviously there are multiple, so many categories of mutual funds, but you have equity only categories, large, mid, small, uh, and certain others. And then you have debt, multiple categories in debt. And then you have hybrid categories also, which is a mix of equity and debt. And then you have asset allocation. So then obviously it's not very straightforward. You have mutual funds, again, was meant to simplify our lives, but now we have so many types of mutual funds, so many categories, and within each category you have mutual funds. So it's not, I can understand it's not an easy task, but mutual fund is a very, very good vehicle to invest and save and invest your money. And depending on your risk profile, you can actually select from these mutual funds. Again, not an easy task, but yeah, you can take exposure to any of these asset classes through mutual funds.
Actually, Shivakumar, if you want to see the true equity exposure of your mutual funds, you can visit our app. You can download Good Luck
Yeah.
application from Play Store, and we'll import all your mutual fund holdings and transaction data, and we actually tell you exactly what your underlying equity and debt and even cash allocation is. So you should definitely give it a try. Next question we have from Manish. He is asking, he has invested in Nifty 50 ETF of about 50 to 70% allocation and in gold ETF about 30 to 50% allocation. Should it be termed as equity and debt, or would basically the question is, would you see gold as debt or not?
Sorry, would you see gold as
Debt or not?
debt? Not really. Although it's uncorrelated to equity, it's not as correlated, but it can't be considered as debt because it's equally volatile actually. Gold is equally volatile, and and it does not really provide that kind of stability the the debt is going to provide. So definitely I think in all of this, to me it looks like, from just looking at this, it looks like you have much higher allocation to gold than you should have. So maybe divert a part of it to debt. That is going to make this specific portfolio more safer, more stable. But again, it depends on the kind of risk appetite one has. But gold really can't be a substitute to debt.
Okay. Anil is asking, my annual expense is 24 lakhs. Can you tell me the breakup into fixed deposit, equity, mutual funds, and gold? My age is 55. What should be the corpus if I plan to retire at 58?
Okay. So his age is 55. He's still earning, but moving towards retirement, maybe uh, 3 years down the line, he wants to retire. I think this would again depend on the risk profile of the person, but because he's very close to retirement, let's say if he has at retirement, I think the average one should have is maybe about one should have maybe about 40 to 50% in equity. That's the average case scenario, right? At retirement. So let's say I'm just assuming here that let's say he has currently about 70% in equity, and at retirement he plans to have maybe about say 40% in equity. So over the course of next 3 to 4 years, what he should be doing is reducing his exposure in equity and bringing it somewhere around 40 to 50%. That's what he should be doing over the next couple of years. Again, how much he should have in retirement, I think we already answered that question. That number would be somewhere around 30 to 35x of his annual expenses. So if the annual expenses are 24 lakhs, so 30 to 35 times of that should be the range of his retirement corpus, and in his retirement corpus have maybe between 30 to 60% of equity depending on his risk profile. Definitely not have more than 60%, it's not going to help him a lot, and below 30 20% will be very very conservative number. So those are my initial thoughts.
Sachin is asking us, he has a portfolio of 1.5 crores, which is divided into 50 lakhs into debt, 60 lakhs into stocks, and 40 lakhs into mutual funds, which I assume is primarily equity only. So, overwhelmingly, majority of the portfolio, almost two-thirds of the portfolio is into equity, and one-third is into debt. And he wants to withdraw 40,000 rupees monthly. Uh, is it a possible situation for Sachin?
So again, going back to those calculations, Ankit, in this case, 40 lakhs would translate, sorry, 40,000 per month would translate to 4.8 lakhs. So let's assume that 5 lakhs only. Now 5 lakhs into 30x is 1.5 crores, right? So that's the bare minimum one should have. I think what you mentioned is he has 1.5 crores. So he's just about there. His equity is also broadly in line. It's about 67%. Over the next maybe 2 3 years, try and reduce that a bit to about 50% or so, in that range is what I would suggest. So it's not too out of line also. And his retirement corpus is just about there. So yeah, maybe he can think about it, or if he takes another 2 3 years, want to increase it slightly to 35x, that will give him that much needed buffer as well. But maybe yeah, you can think about as with 30x also. It's a pretty decent number.
We have another question from Arun. He doesn't like debt. He is 45 years old and is 90% into equity. He has never invested in debt and is asking us whether REITs are a good option to diversify.
Yeah. So Arun, I think if you are still far away from your retirement, still earning, saving money, 90% still is still higher, but maybe you can do with it. Even personally, I don't like debt so much. I have also invested in real estate, but I still don't have 90%. Maybe I have lower number in equities, 50 60%. So overall, 90% to me looks very high. I'm not sure whether he has the risk appetite, uh, because if let's say equities were to correct 30 40%, would he be comfortable holding to that? That is one thing. If he would be comfortable, maybe it's okay. And REITs is fine. I think REITs give you about 5 to 6% in regular income, and another maybe 4 5%. So it's about you'll be actually able to beat inflation. That's the assumption in REITs. So they are pretty good. But as and when he moves towards retirement, I think he should definitely reduce his exposure to equity. Uh, so maybe it's fine right now, but towards retirement, definitely he should reduce this exposure towards equity. And if he's not comfortable, I think REITs is pretty good. He can increase his exposure towards REIT to make it more stable.
Vivek, REITs are a decent option if you want to get into the real estate exposure but don't want to suffer the illiquidity that
Yeah.
real estate
Yeah.
comes with. However, they have displayed historically very high amount of correlation with the overall equity market. So if the purpose is diversification, do you think REITs are a good option?
I think they'll be good option because see, till now we have had very less uh, time frame really, and less number of reads also, and less time frames. Historically, if you look at let's say US markets where the reads is quite liquid, also there's huge amount of depth and breadth in reads. They do definitely provide you good amount of diversification benefits. So I think going ahead, definitely that's going to be the case, that even in Indian markets, it should be a uh, decent diversification option. But I do agree. See, what happens is, I think REITs started listing just before COVID hit.
Yeah.
And what happens in these kind of crises is initially, even the safest of assets really go down. So even I think if you consider even gold, which is one of the safest assets, during crisis, those few days where the crisis is at its peak, when equity markets are correcting, you have a lot of margin call, and people are actually selling all the other asset classes, whether they are correlated or not. They're selling those asset classes just to raise money to either invest in equity or to meet those margin calls. And that's why in those few days or weeks of crisis, you see correlation in almost all the asset classes. And with time, then you start seeing divergence. So even with dollar, everything really falls down during those couple of weeks of crisis. And then obviously the diversification kicks in. That's what happens. So I think even in case of REITs, that's what typically happened. But as and when the real estate markets mature, obviously it should definitely provide you diversification benefits.
Even within real estate market, there is a big distinction between commercial real estate and residential real estate. While residential real estate can provide diversification benefits, the most of the, in fact, all of the REITs listed in
Yeah.
India right now, all four or five, they are either business parks or own, commercial properties, malls, and everything.
Malls. Yeah.
So their economic cycle tends to be very correlated with the equities
Weekly equity.
business cycle. So perhaps in future, when we start having more and more REITs in the Indian market,
Yeah.
they can be a
That's
good
what I
diversifier.
think that's an interesting, definitely very interesting asset class. And as and when market matures, we have more depth and breadth in REITs. I remember seeing one research in US. They have multiple kind of REITs, and the one that did well, if I remember correctly, even it did better than equity market returns, was the REITs which invest in warehouses. So specifically and even now we see there's a lot of activity in warehouses in India, although there are no REITs available, but that specific asset class which the REITs that invest in warehouses was the best performing REIT in the US markets. So obviously I'm sure in the near future there are going to be all kind of REITs investing in multiple kind of uh, real estates, be it commercial or warehouses or residential. Maybe residential, I'm not sure. It's going to take much longer, but definitely other kind of commercial, other types of commercial real estate, definitely I think we are going to see.
Okay, so we are running out of time. We'll just take one another question. It's an interesting question from Ram. He is 49 years old and has reached its fire number, which is 33 times his annual expense. And he's asking us whether he should stay invested in the market and expose his money to market risk, or should he just withdraw all the money and put it into a bank, fixed deposit, or just keep it in the savings account.
Yeah, no, I think that 33x number, the way it comes is the assumption is definitely you need uh, the growth in your equity part. So I think definitely what you can't do is put it in a bank and then withdraw, because your portfolio is not going to grow at a pace, whereas your expenses are definitely going to grow at the rate of inflation. So that is definitely, you cannot afford to put all your money in, say, bank, FD, and just retire peacefully with 33x. That is definitely not possible. You've got to have at least, say, about 40% or decent part in equity. Only then you can afford to retire with 33x. So yeah, banks is definitely not possible in this case.
Thank you, Vivek, for this wonderful session. We are out of time now. In case we missed your question, we are sorry. We have limited time. This session will be available on our YouTube channel, which is goodluck.com. You can revisit any sections of this webinar in case you missed it. Once again, thank you, Vivek. Thank you, everyone, for joining in.